Take it back a slide. All right, so tonight we're going to talk about mutual funds and other investments. Um, the situation with mutual funds is typically mutual funds are made up of different equity stocks. So for the most part, they can be made up of different sectors. They can also have bonds in them. There can also be some that are sort of a hybrid that have some real estate type things in them. But by and large, they are stocks. And the things that mutual funds do, or the function of mutual funds, is it, in theory, provides you a professionally managed um, group of stocks, and it also provides you some diversification. Since you aren't holding stock in just one company, if that one company, happened to go out of business, that would be very bad. So since you have mutual funds, you should have a bit of protection there. Now, the bit about the professional management, that hasn't always worked out. A lot of mutual funds have been found not to perform that well, and in fact, you're paying a management fee, a 12B fee, and so what that has led to is it's led to some folks just going with what they call indexed funds, where there is sort of a manager involved, but he doesn't have a very big job because all he's going to do is maintain a sample of what's in the S&P 500 or the Dow Jones or whatever, and so the management fees are lower, and the performance, there's so much randomness in the stock market. They found the performance of many of those funds is comparable to these ones where you get people, definitely involved in some sort of hands-on kind of approach. So that's kind of an overview. Um, Different objectives, characteristics, classified mutual funds performance, and how and why mutual funds are bought and sold. A lot of folks have got mutual funds. Probably, I would venture, maybe a third or even a half of the class at this point. You may own them directly, or they may be what they call institutional investments. A lot of times you find, pension funds, union funds, variety of funds are invested in different mutual funds. They call those guys institutional investors. But you can also buy them privately, and that's the beauty of mutual funds. Very easy to do, and small increments. It's not, you aren't really dealing with a certain number of shares or whatever. If you're willing to commit to a company that you're going to invest, say, $25 a month, there's usually a program, and granted, the expectation is that you're going to build from that smaller investment, but just the same, they aren't at all put out that you want to set up some sort of small investment fund, and it's a good way to go. And theoretically, you've got somebody professionally managing it, so you can watch the performance, and you can see how your guy is doing. Anyway, 87 million individuals own mutual funds, so that's a lot of folks. And it's like I say, it's easier, and it's a little less trauma. Stocks aren't that hard to buy, especially in the um, you know uh, online trading. But you are kind of only a mouse click away from some very bad consequences if you don't know what you're doing. Mutual funds are probably a little more user friendly. Um, they've been growing, in the 70s, not a whole lot, and now there's a ton of them. So actually, in some studies I've seen that there's more mutual funds than there are individual stocks. So that could happen. Anyway, professional management. Again, some people call in the question whether these guys do too much fiddling, too much buying and selling, and actually degrade the performance of the fund. Um, but there's certain managers out there, some of the guys with Vanguard or Fidelity that are, kind of legends because they've had a history of good returns. So um, if you are looking at a mutual fund and you are selecting it based upon past performance, well, you want to make sure that that team that got that past performance still exists, or they haven't just moved on and now you've got some other team trading on it. Um, Scandal involving late trading. There's always going to be scandals in any sort of stock situation, insider information and all that. I don't see that as being unique to mutual funds. major reasons investors purchase mutual funds, yeah, the diversification. Since they own a number of stocks, it does inherently provide you some diversity. Now again, it's going to temper things a bit. If you've got, if you say had Google from the start, well, there's no mutual fund that's going to compete with that, but mutual funds that had Google in their portfolio probably did quite well. But they were, the overall results were kind of tempered by some of the other success factors. So again, if you're looking for good growth but want some diversification, there's probably a mutual fund out there that will deliver that for you. They talked about closed-end funds. Um, it's these are not typical, just 2%, so we're not going to spend a whole lot of time on it. But um, you know, it's just kind of a closed group, and you will see certain funds that were closed even on some of the big boys, some of the big fund companies, where you basically couldn't get into that fund and you had to buy existing shares from somebody else. You also have exchange traded funds, which are just, these are the ones that are just invested in a small specific stock index. And then largely are the open-ended funds. Now, you know, shares issued and redeemed, investors can buy and sell shares at the net asset value, and then asset value is just established by the underlying stocks plus any liabilities they have. One thing about the closed-end things, and sometimes some of these large funds, especially if they're trying to invest in small cap type stocks, sometimes just the turbulence of this huge fund, it's like a big Goliath, this big gorilla, and they show interest in a company, and that interest of a huge mutual fund with a lot of investors behind it can mess with that stock price. And so that is one of the arguments for some of the closed funds where they want to limit the amount of assets and the number of people involved in it because they don't want to have a detrimental effect or an adverse effect on the underlying stocks. So you may see that, but that is one because especially some of the aggressive mutual funds that invest in small caps, there's really no way, small caps meaning small capitalized stocks of smaller growing companies. You can imagine what would happen. It's just supply and demand. You get a big mutual fund company and they're starting to buy up shares, and that is going to drive up the supply and drive up the stock price. Net asset value. So this is how they establish the price. Value of the fund's portfolio. So the collections, all the closing prices of their particular stocks they own, minus the liabilities, and then number of outstanding shares. But again, they talk about in the book that some of these salesmen are overbearing or whatever. I've never found that the case. Now, I've never buy from anybody who's soliciting stocks. Who, if I do my research on the internet and in the magazines, and I contact those people directly. I don't buy anything from anybody who calls me. I try to discourage those people. But anyway, I've never had any problems, and most of these people have been pretty polite. And they by law have to send you a thing called a prospectus that tells you how the fund operates, and it's usually a pretty pleasant experience, and they'll help you set some goals and accomplish what you want. So I've never had a problem. Now there are two other ways to classify funds, and I touched on this last week between loaded funds and no load funds. And just categorically, I've never bought a loaded fund. A lot of times, the loaded funds will have salesmen because, you know, they no salesman would have any interest working on a no load fund because they don't have those upfront expenses. So, a no load fund, obviously, they are going to have some marketing type things. They are going to have some charges, but they aren't going to have the same, level typically as a loaded fund. But the even if the charges were the same, it's when the charges are taken from your account that's the problem with loaded funds. Loaded funds, obviously, the salesman, he wants his money, up front, and so you go to invest $10,000, and his commission is 750. Well, you're only investing 92, 92.50. So the problem is that since you took that commission up front, um, before you've had any time value of money to work on that money, that's going to be a pretty big dent on a loaded fund. If they say took their 750 or whatever after that fund's grown for a while, that's not going to be as big a hit. But if you take all that money up front, it decreases the amount of money you have to invest. And I have run into pressure type salesmen and these type of things, and you may have it in your own community. In the military, they had a certain group of folks that were usually retired officers, and they'd prey upon the new guys, and they were just kind of unprofessional. So those guys might be a problem. But on the no load side, um, everybody I've ever dealt with, whether it's Janus, Fidelity, Magellan, um, guys through USA, if you use them. Anyway, there's ING. I've never had a bad experience, but again, I'm not dealing with salesmen. I'm dealing with just people who are interested in helping you process things and not nearly as bad. Here you have the contingent deferred sales load, so back end load. So charge upon withdrawal of funds. So if you're going to keep the funds in for some time, that charge that comes out at the end, granted it's we're talking up to 8.5% on the front end load. Here 1 to 5%, it may be a considerable amount of money, but that's to their benefit to grow your mutual fund shares, and so their commission on the exit would be higher. But generally, if you're going to keep the funds for a long time, like over 5 years, um, it'll be even a less charge. So anyway, I see really no need for loaded funds. I've always been a no load guy, and I've never seen anything to change my mind on that. Management fee, these are these fees for a 0.5%, 1%. So again, gets back to the argument I was talking about with the index funds, where there's not a whole lot of management required. They just buy representative stocks within that index and let it go, and that management fee is less. So they can reduce that fee and more interest stays with you. And then the 12B fees, those costs cannot exceed 1% per year. But again, everybody's got to get paid somehow. But on the no load funds, even with the 12B fees, they're generally quite a bit less. Expense ratio. So you do want to keep track. I mean, there are some managers that might whatever, but this is all written up when you're evaluating the fund. You do your due diligence. They send you a prospectus, and you will look at all these costs, and yeah, just be assured that it's not going to exceed the 1%. But you won't have a very tough time with this, because if they are charging excessive management fees, folks like Morningstar or Value Line or whatever will call attention to that, and don't worry about that. You'll be those folks are sorted out pretty quickly. So again, depending on what your appetite is for risk, and what your goals are, and really what stage of your life you're in, what your how far out you're looking, you can find equity funds, stock funds that will match those sorts of goals. So aggressive growth, obviously small caps, fast growing companies. Equity, these are people who want to get money from the dividends. And then if you feel that you want to reach out a little bit and get away from just U.S. stocks, you would go with a global stock fund. Now those can have U.S. stocks and also other countries. International funds, they would only have international stocks. But again, if you want to invest internationally, it would be kind of a nightmare to do that with individual, foreign exchanges and all that, the tax implications. You would just be looking for lots of headaches. If you really do want to invest internationally, a mutual fund is probably your better way to go. Growth stock, so obviously somewhere in between aggressive growth and conservative. Index, discuss that. International, only international things, and then large caps are just some of the big boys defined as 10 billion or more. Mid caps, regional sectors, so socially responsible. You know, sometimes some of these socially responsible funds. A guy today was telling me, "Man, I can't figure out what's going on with Tesla. You know, the company they build these electric cars." He said they aren't making any money. Their cars are catching fire, but their stock's still going up. Well, there are some socially responsible mutual funds that, per their, you know, shareholders' agreement, they have to invest in companies that have that kind of business model. Now, it may work out for them in the end, but anyway, that is going to you know, invite more investment due to that requirement. Bond funds, yeah, high yield equals junk. So we talked about bonds last week. B and C class bonds are junk. D's are in defaults, so not good. Corporate bonds, intermediate corporates, intermediate U.S. and long-term corporates. Like I've said, the bond right now, the situation with bonds, with interest rates being artificially low, there's only one way they can go is up, and when that happens, bonds get clobbered. So um, at 5-10 years down the road, you want to invest in bonds, you may revisit it. But right now, anybody who encourages you to invest in bonds is probably got some other something else going on. Long-term U.S. bonds, again, won't keep up generally with inflation. Munis, good, tax-free, but again, you need to beat inflation. And short-term corporate, now 1 to 5 years, that might be something. It's just a long-term type bond that's really going to get clobbered by the interest rate changes. Short-term U.S. bonds and then world bonds. So you can see that through mutual funds, what you can do is you can, you know, find the kind of investment you would like, and then since you're buying in a mutual fund, you can diversify a bit by having a collection of those funds, and then also not have to deal with you know, the individual details that go along with each stock, trying to keep track of each company. There's a manager to do that with a mutual fund. Asset allocation funds. So again, this is even more diversification, where, you know, based upon the market, and again, this is putting a lot of weight on the manager to know, you know, when to be in stocks, when to be in bonds, and that's a pretty challenging management decision. Right now, though, being in equities and not in bonds, most people would go that way. And then balanced funds. Again, a lot of this comes down to marketing. You know, one guy's balanced fund is somebody else's. Well, that's too high and whatever. So you have to compare them individually. Funds of funds, life cycle funds. Life cycle funds, what they do is they would use like an asset allocation type thing for, say, your child's going to go to college in 20 years. You start investing in the fund now. When they're very young, it's going to be very aggressive. When they get within 3 or 4 years of college, the target date, it's going to get more conservative. And then when it's time to withdraw, when that child should be starting college, then it's very conservative. And the same thing would happen with the retirement. So they'll have these, you know, target dates for those. Money market funds, yeah. Again, not a lot of risk. I don't really see the need other than the ease of buying them, but diversification in the money market is not usually necessary. So most of these mutual fund companies, they want to make themselves sort of one-stop shopping, and so they will have a whole family of funds, and you can trade back and forth in between them, and usually no penalties incurred. But again, now you're, you know, you're doing some market timing, and you know, that's not necessarily a bad thing, but it is a strategy. You know, I've known a lot of folks who are anticipating the market to fall, so they're putting the money in cash. Well, if you've done that for the past 6 months, you could have done very well by staying in the market. So it's hard to tell what's happening, especially with the role the Fed plays in the mix. Evaluate mutual funds for investment purposes. So professional manager we talked about. Indexes, very little management. It's just going to be that mirror image of the index. So, and this is what I was talking about before. Some of these guys, especially when you add in their management fee, they do a lot of trading, and all they're doing is, a little bit behind the curve, and wrong on a couple trades, and experience has shown that some of these guys could have done better by just leaving it alone. Internet, yeah, like I've said, not a huge fan of finance or Yahoo other than just checking quotes. Business Week, again, I'm more of the Morningstar or Value Line in that mix. Perhaps Barron's, but Smart Money I do not care for either, or Money Magazine. A lot of times what they do is they chase the ones that did very well last year, and so sometimes people get lucky, they make a good trade, and now you're betting on something. You invest in that fund, and it's at the pinnacle, it's at the very top of its apex there, and it's got nowhere to go but down. And sometimes some of the Smart Money and Money are written in such a layman's, friendly type literature that they gloss over the technical details that some of the more serious publications like Morningstar or Value Line or Barron's would have. Newspaper mutual funds, it's not, if you're investing in mutual funds, if you're investing in stocks, um, and you're getting those numbers out of the newspaper, you're going to get burned. The information is dated by the time you get to it. So those same sources would be available online. But the difference between stocks and mutual funds in terms of buying and selling, things happen a bit quicker in stocks that when you trade, you're traded throughout the day. Mutual funds, because they've got a collection of stocks, they set a net asset value at the end of the day. So, if you trade on something, say at 8 o'clock in the morning, because you think the market's going to go up, well, you probably should have waited till the end of the day when there's more certainty that the market was going to move the way you thought it was, because they're going to settle out at the end of the day with the closing prices. With stocks, they'll be traded throughout the day, so a little different there. If you're doing dollar cost averaging, being regular investments, those little fluctuations shouldn't matter much. But jumping in and out of mutual funds, they're always done at the closing price at the end of the day. The prospectus, this is the literature. The minute you call up a mutual fund company and start talking to them, a lot of times they won't even talk to you until you've got the prospectus. They've got some legal requirements. It's kind of like real estate where a good licensee does not talk to a client until they've given the AREC form, the disclosure form. It's the same sort of thing. You can get yourself in, the seller, the mutual fund company, can get themselves in a lot of trouble if you don't have the prospectus in before you invest. So the prospectus will pardon me, go through and describe the fund strategy and have a lot of graphs and a lot of other technical information, and it's pretty useful. That and a side-by-side comparison of the other mutual funds that you're considering is the way you need to go about it. Financial publications, so again, Forbes is good. Not a big fan of Money, like I said. In terms of TV, there's, I know most people have strong opinions either way on Fox News, but the one show that's pretty reasonable on there is Cavuto, Neil Cavuto, and they have their own business channel. So if I was going to, spend some time trying to figure out the market, that's a good source as well. Money Magazine, Investor's Guide, again, they always have the the Investor's Guide, and you're really drawn to the one that did really well last year, and you really need to look at maybe a 5-year record or something unusual that may have caused that outstanding performance. So I've done that before. I've just picked the top ones, and then I was kind of disappointed because they weren't necessarily the top ones year to year. So that's when I was younger, and now I do a little bit differently. How mutual funds? Okay, so completely easy. You call the folks, they send you a prospectus. You set up something either with your bank, either with them, especially if you're willing to go on some sort of regular payment schedule. Not payment schedule, but investment schedule. Even as little as 25 bucks a month. Very easy to deal with, and very user friendly, and it's a fairly good experience. I've never had any real problems with those folks. Um, on these, whenever I get the investment type forms, I always check both of these to be reinvested. So I never, if I'm still in the investment stage of my life, um, I didn't really see the need to be spending the dividends and the capital gains I wanted reinvested. So now this may generate some, deals for you at tax time, and if it's going to put a burden on you to have to pay the taxes, um, out of your personal income, your non-investment income, yeah, you might consider, using the dividends or some of the capital gains to pay off the taxes that these mutual funds generated. But usually I've just paid those from other funds. But anyway, if you're generating dividends and generating capital gains, that means that you're probably doing pretty well. So no complaints there. But anyway, you'll get some simple, you'll get a piece of paperwork or two from each mutual fund, um, on the quarter, unless you sign up to do it electronically. And at the end of the year, you'll get a tax statement, a DIV or a whatever, to claim that income or that capital gains. Not a huge headache, and they're very helpful with the paperwork. Capital gains distribution. So again, capital gains would be that they had some sort of sale throughout the year. The manager decided that that particular stock had ran up pretty well. He sells it, locks in those gains, and that generates a capital gain. So that's what you're going to get taxed on. And right as they say, income and capital gains can be automatically reinvested, which is usually what I do. If you had just a small amount of shares, especially if you're starting out, getting a check or some credit for, you know, 50 cents or $5 or whatever, it's probably more hassle than it's worth. So it's just easier to reinvest them in my mind. Funds reinvested, purchase of additional shares, still taxable, yes. Turnover rate, yeah, those are certain ones that measures the percentage of fund that have been replaced in 1 year. So it can affect your taxes on tax deferred type things. 401k normally for private, and 403b for nonprofits, educational type things. Purchase options, I would go with the automatic investments. It's just that easy, and again, it's just taken from your paycheck and fairly painless. Reinvest the capital gains and dividends. Usually you can transfer the funds if you have some sort of telephone password, and then withdrawals are the same way, just as easy. Apologize, I've got a bit of a cold tonight. So, did anybody, I notice we've got a few people out there, did anybody have any questions on mutual funds, anything they didn't understand, anything we've talked about? They're, in terms of getting in, for the typical college student, aggressive growth or growth mutual fund, something that's going to build up over the long term is the way to go. And if you have anything with the company or organization you work with that has some sort of matching, by all means take advantage of it. And whichever way you come about owning these mutual funds, obviously if they're going to have some sort of matching program, that's the best way to go. But I like investing in stocks sometimes, but that's more of a sport kind of gambling thing, and not as disciplined as the mutual funds. At least that's the way I view it. All right, investing in real estate. So I have a real estate license here in the state of Alaska. I've had it for a few years. Worked with Remax and a couple other brokers. I'm actually now on a referral with Prudential. But anyway, different real estate investments. again, if you know, especially if you're going to be staying up here in Alaska and the area, and you um, are going to be in a situation where you'd be able to, maybe buy a rental property, or maybe you're going to live in a house and it's kind of a starter, and rather than sell it outright, you're going to move on and leave that your previous home as a rental. That's always a good way to do it. So, apologize, I've got a bit of a cold tonight, so if I cough, it's not good. Direct real estate investments. So that's what we're talking about. Where I was just saying, you owned a home or you just bought some rental property, and you are directly invested in it. Um, they're talking about here is your home as investment, the actual home you're living in. Um, that is a good idea in terms of the tax breaks that are available to you. There's a very strong, the Realtors Association is very strong, and they protect that homeowner's tax credit where your mortgage interest is deductible. They have tried to take that away a few times. If it does happen, that would be quite detrimental to the real estate market. So I don't think that's going to happen. But anyway, it does make investing in real estate uh, very attractive. Shelter income from taxes, interest deductible, yes. Be aware of real estate bubbles. Um, they can occur, you know. Up here in Alaska, obviously it was before my time, but they had a big one back in the late 80s. Um, some places though are just one bubble to another, Las Vegas and Miami Beach and places like that. Truly speculative markets. Here, I don't think you've got that same issue. Here also, in terms of real estate investment for rental type property, the fact that there's a high percentage of military is a good thing, because those are folks who are fairly good quality renters, in the fact that they would typically buy a home if they're going to be here long enough, but they have steady income, and they're going to be here, say, 3 years or whatever. That does help to stabilize the real estate market, rather than folks that are in some awkward financial position and are renters their whole life. um, Vacation home, you can call a vacation home and get all the same deductions, but uh, you can't rent it more than 14 days a year. So if you do rent more than 14 days a year, then you can deduct things, but only against the rental income. So it's a little more confusing. But if you don't rent it, then it's just as if your own house was that much bigger. So, but yeah, there's a lot of folks here who would like to have a cabin out in the woods and all that. That is certainly a vacation home, and all that interest and expenses, that's deductible. Commercial property. So theoretically, they're talking about duplexes and condos as commercial properties as well. For a lot of people, those are their homes. We'll live in one half and rent out the other. Hotels, office buildings, that type of commercial real estate is probably beyond the scope of this course. But there's a student who was in my 377 class. She's got a duplex out in Wasilla, and she's doing quite well. And it is a comparatively against the other investments, it's pretty good. Property values can go up and down, but generally they do go up. Um, so this has to do with cash flow. Will income be greater than expenses? Um, that'd be positive cash flow. And tax deductions are limited in the amount of rental income you receive. So they make a big deal too out of passive and passive activities and passive losses. If you're directly involved, you are not passive. If it's managed by somebody else, third party, then you can be considered passive. Undeveloped land. This is yeah, they're saying this is usually it's just a sucking wound. I've got a couple pieces of property down in Florida. Yeah, all I pay is taxes and homeowners association stuff, and yeah, they were bought because the property value is supposed to appreciate. That didn't quite work out, but anyway, still got them. And yeah, idea of subdividing the land. You can already buy land that's subdivided, just buy a vacant lot. At the time, the market was going through the roof, and I bought it as a hedge. But anyway, they're right that there is some risk, but there's risk in developed property too. I mean, this stuff is just beachfront. It's not going anywhere, so I'm not too concerned. Real estate syndicates or limited partnerships. This sounds kind of when they talk about syndicates, it sounds kind of nefarious, like there's some criminal organization. But anyway, it really is nothing more than a temporary association. So come together for a limited time, limited purpose to buy some property. Professional management and limited liability for its members. So the members, you can't be involved. You're going to have to sort of turn over the reins to the manager, or else you're going to be um, ex- exposed to the full liability of the project if the project goes way south. So if you're in a passive role in a limited partnership, you need to stay in that passive role to keep yourself from being exposed to risks that you don't want to be involved in. So typically, if you're just a limited passive partner, the only risk exposure you have is to the amount of money that you have invested. If you're a full partner with no limit on there, yeah, they can come after other assets of yours more than what you had invested. So you want to be careful. Limited partner has a general partner. Now that, yeah, somebody's got to have the unlimited liability. That's the general partner. So, and just as I said, the partner's liability is limited to the extent of their initial investment in the limited partnership. REITs, real estate investment trusts. So again, this is a bigger, more organized than a syndicate. This isn't some temporary organization. This is basically a mutual fund that deals with property. And in order to qualify as a real estate investment trust, they have to meet certain conditions. They have to have a certain number. So investing in first and second mortgages, participation. Okay, I thought they'd go in a little bit more detail into REITs, but for a REIT to be stood up, it needs to have certain specific requirements that obviously if somebody's advertising themselves as a REIT, you would want to make sure they do fulfill that, but usually it's 99 folks or more and certain asset requirements. So if you're looking at a mutual fund that's focused in real estate, a REIT would be one method of doing that. Invest in first and second mortgages, so a risk-proof real estate investment. Yeah, not always. Things derivatives. Derivatives are basically investments that derive their value from another investment. So that's what kind of brought up this whole real estate collapse, where people got confused or tried to confuse people on what the underlying certificates were, and they claimed they had mortgage certificates, that they were derivatives of these mortgage certificates. Well, what they lost track of was that the underlying certificates were worthless. So that can be a bit dangerous. But you can invest in Ginnie Mae and Freddie Mac. They're different semi-government mortgage institutions. Evaluate the advantage of real estate investments. A hedge against inflation. This can work to a certain degree, and yeah, it can have some easy entry. You will have some liquidity issues, but the issue I would use in terms of inflation in the market. Let's say you're looking at a house and your dream house is 500,000 and the only house you can afford right now is 250,000. So you invest in this $250,000 home, the market goes up considerably, it doubles. So your house is now worth 500,000, but your dream house also went up. It's now worth $1 million. So initially you're only 250,000 behind. Now you're $500,000 behind. So again, it's a double-edged sword. Inflation in the housing market. The only thing worse would be sitting on the sidelines, able to buy a $250,000 house, and now seeing that go up to 500,000 and still wanting that $1 million house. So it's not a win situation by sitting on the sidelines, but again, it's not a win situation by having rampant inflation. Limited financial liabilities when you do the passive ownership, no management concern in the REITs, and financial leverage, borrowed funds for investment. And again, we talked about in stock market how when you leverage stocks, that can be kind of dangerous because of the stock values changing in price and you having to meet margin calls. But in the real estate market, because it's a bit more secure investment, it's collateralized. You can, you know, get in at a low price, and if that real estate were to go up, you can do quite well with borrowed money, and the interest rates are going to be quite low. So just the same, if the market goes way down, you can get yourself in a lot of trouble. On that same beach where I have some property, some people bought a condo for $850,000, which now worth $350,000, and these people are going to be working the rest of their lives to pay off that bill. So it is, it's a two-edged sword when you're leveraged in things. Things about real estate: illiquidity. It means it's, you do have to. It's not like just stocks where you just put it on the market and it's sold. Declining property values. A lot of places in the Rust Belt and Detroit and Cleveland where they're giving away homes. They're just knocking them down. You are stuck in a certain market. The real estate syndicates don't offer the tax shelter and depreciation and management problems. If you're doing direct real estate and you've got tenants that are a headache, you've got tenants that are a headache. I mean, there's no way away from it. So, investing in precious metal gems and collections. At the outset, I don't know that, in terms of personal finance, this is not something I would typically jump into. Maybe the only thing would be gold in terms of a partial sort of an asset allocation strategy. But some of the other things of precious metals, gems, collectibles, um, that is difficult. Um, you know, my main problem is I've been to so many places, especially in the Middle East, where things are counterfeit. Counterfeit gold, counterfeit gems, counterfeit everything. So, um, if you want to get legitimate stuff, you're going to have to buy it at the most, expensive place to be assured of its authenticity. And then, your investment is, well, you just paid top dollar for your investment. So I don't know if you could buy something on eBay or some collectors type eBay and be assured of its authenticity. I might be apt to do it, but and then the storage business, where are you going to keep the stuff, and how much are you going to have to pay for that. You can invest in coins, in terms of the gold, different ways to hold gold. And again, in Alaska, if you know gold and you do have access, obviously in this town, to assay offices and things like that, and you can be certain of it. That might be a definite way to get around the bogus counterfeit lead gold type stuff. But the other issue is in terms of gold performing as a investment, it makes some pretty good swings now and then, especially when there's worldwide turbulence. It tends to go way up, but in the long haul, stocks and other things tend to outperform it. So there's a lot of people who hold gold, and maybe as a portion of your portfolio, but to dump all your money into it, I don't think would be a wise strategy. It's almost like holding cash. I mean, it's worth more than cash, obviously, because the value is going to endure, but it's difficult. I have looked at silver. There's lots of practical reasons. Gold too. Gold has industrial uses, as does silver. So uh, again, maybe a sector, or maybe if you're interested in that, there are mutual funds that deal with precious metals as well. Again, now you're dealing with the whole, all your money being held electronically, and if the whole world collapses, you don't have the gold in your hand. But if you think silver is just going to appreciate as an investment, or any one of these precious metals, and you're confident of the world not truly collapsing, then mutual funds would allow you to get a stake in that market. Precious stones, I would never touch them, because for me, I've always looked at like the secondary market. Um, when I was in Afghanistan, we even got over by the Iranian border. There were rugs and phenomenal quality, phenomenal expense, but and they sell for huge amounts of money at certain boutiques like in New York or Paris or whatever. But um, you're probably not going to be selling your particular investment in that sort of boutique, so you're going to have to get some sort of discounted rate. The stones, I've seen some nice stones that, and again, I didn't invest a whole lot of money, but I was thankful I didn't, because when I brought them back, I found out, yeah, they literally were glass, and so we're talking, $800 down the ground, but not as bad as what it could have been. Difficult get knowing you're getting a good stone. And De Beers, they do control the supply if they want to open it up or close it down. And then you get in the whole situation with blood diamonds. I just would not see in terms of investment, um, why I would want to go with precious gems. Collectibles, um, yeah, again, just fun to have if you enjoy them, but and being an investment class type item, um, if that's your expertise, maybe so, but it's certainly not mine, and I would not do it. Also, when they talk about real estate being not very liquid market, I can only imagine. I mean, when somebody says something is worth whatever, the worth of any item is only what somebody else is willing to pay for it. So it may be worth a lot to you, but unless you've got a buyer standing by, it's not. Collectibles on the net. Yeah, I buy a lot of stuff on eBay, but not investments. I have enough trouble just buying regular stuff. Disadvantage of purchasing, obviously, uh, everything about it. I mean, again, I would look at this sort of the same way I invest in some of the stock markets. Sometimes you see a company, you think, that's going to do good things. I don't know much about it, but it's fun, and this is $1,000 I'm going to waste on something else. I'm going to do it. But that's more of a gambling type thing, and I would put this stuff in the same category. You would not want to put your child's future education or your retirement based upon collectibles you're buying over the internet. And that's it. So, any questions? So, anything's fair game. Mutual funds, bonds. If anybody has any questions, shoot me an email. Um, if I was teaching this class 10 years ago, I would have been the biggest proponent of real estate ever, saying that you could never ever lose money because it just doesn't happen, doesn't go down. And I wasn't burned badly, but I saw a lot of people who were. So, and now the stock market's going nuts, not for any rational reasons, but people know that it's basically a bubble, and the Fed right now is still pumping. If they put Yellen, the new Fed director, in there, she's stated that she implies to continue that process. But once they start tapering, and tapering will be tapering the amount of money that they're infusing into the market, you'll see the market start to slow down a bit. And whether that will end gently or with a crash, who knows? But I wouldn't tell you to pull your money out of the market right now, because if you did in the past, since last year, you would have lost 25%. The market went up over 25% this year, at least S&P did. So anyway, good luck. A lot to think about, but probably the best advice is look at some of the mutual fund companies and call for a prospectus and take a look and compare and ask people questions. Thanks. Good night.